Welcome back to the Golfi Real Estate Show. I'm your host, Steph Vivier. Rob Golfi is here, as well as sales representative with the Golfi team, Samantha Kilburn. And Rob and Samantha, you guys are bringing us great information, not only if you're wanting to get into the real estate market, but also for us current homeowners. And we've all been watching with broken hearts the devastating wildfires that are happening in Southern California right now. And more of these weather events, these unexpected weather events are happening. And it does make us wonder if we're covered for unexpected disasters. Rob, this is probably something you talk to your clients a lot about.
It is. So the one thing is you have to be careful when you're putting an offer in on a house, because especially if you're near water, if you're near, there's like wetlands or whatever, because insurance companies have different areas flagged, whether they're going to insure it or not, or if it's going to be high premiums. And people don't know this. They just think people just go in and they just put their offer in and they buy the house, and they should call the insurance company and say, listen, I'm purchasing a house on so-and-so street. What's the, what do you insurance companies have this area flagged as?
There's actually a condition that buyers can put in to get insurance, and then make the offer conditional on getting insurance, so they know.
It's very important. So the one thing is, so like these California fires, right? And now there's a lot of wooded areas, forestry, and everything else like that. Now, I was talking to an insurance guy, and he said what they'll do is they'll go in, insurance companies will go in and debrief, and they'll check to see what caused this fire. Now, if it was a person that caused it, or was it something that was natural, like it just, the heat or whatever, they will debrief it, and they'll say, okay, how can this be prevented the next time? Now, if the government doesn't do anything, well, guess what? The insurance companies are going to say, we're not going to insure for fire in this area, or you're going to have to pay a lot more money for insurance. And it's the same thing. Like I was telling the story maybe a couple last year, is that there was a guy that owns a property in across the street from them is the Niagara River, and he's been flooded twice in 10 years. Well, he can't get flood insurance anymore. He's insured. He's insured for a fire. He's insured for breaking and entering. He's insured for everything but flood. So now it's happened twice, and the insurance company says if you want it, you're going to pay a lot more money for it. And so you have to know that. You can't just buy a house and not know what the insurance is going to be on it. Now, there's one insurance that nobody has. They may have it. Very few people have this, that nobody's insured for, because we don't really get natural disasters that happen in Ontario. Okay? Yeah. But there is one insurance. What do you think is not covered on everybody's policy? I mean, we're covered for like if there's a hurricane, we're covered for tornadoes, we're covered for ice and hail, we're covered for, flooding. It depends. Like flooding from coming in from outside in. Yeah. You may not be covered for that. So you got to be careful for that. That's one. But what do you think we're not covered for? You guys are stumped.
I don't know.
Stumped. So earthquakes. We are not covered for earthquakes. Now, we've had earthquakes in the past 50 years, very minor earthquakes, okay? And but the one thing is, if we have an earthquake and the devastations like the ones that you see in San Francisco, everybody's doomed, and the government will have to kick in. But you think you're going to get 100% of your money to rebuild? They're just going to give you maybe 25 cents to 50 cents on the dollar to rebuild. So a lot of people will have to, either rebuild, and slowly governments will give grants to build, and you'll mortgage and you'll the government money to rebuild. So I was talking to my insurance broker, and he said, for a $2,000 policy, if you want earthquake insurance, it's $400 extra. So you're paying $2,400. So that's the one thing we're not insured of. I guarantee I don't have that, and I think most people don't. Like we haven't had earthquakes here are very, very minor, and there's probably been who knows how many in the past 50 years, and it's not enough to pay for it. But we could have one major devastated earthquake and we're in serious trouble. Very serious trouble. So, but the one thing is definitely check for disasters. Like there's like in California, a lot of people aren't insured for it, especially if they live, because we hear about a lot of fires in California, don't we?
Yep.
So
it's pretty common.
yeah, and Fort McMurray had fires. Remember, and I think they had the second one just not too long ago. Remember the big devastation they Fort McMurray in Alberta. Now they had a major one. Everybody had to evacuate, and a lot of people lost their houses. Now I don't know what the scenario there was. But I guarantee you, after that fire, insurance company went in. You probably had to pay more money for insurance for fire insurance. And guess what? They just had one in the last 2-3 years. Another fire that happened. So now the insurance companies are going to put the premiums up more because of it. So if you want to live in the middle of the forest,
and then down in the U.S. in the South, a lot of insurance companies are folding because they can't afford all the claims down there.
No, yeah.
Yeah, it's a lot for sure. With the climate change, that's what's going to happen. But these are all great conversations that, you mentioned before, Rob, that when you're buying a house, like maybe get that insurance quote before you finalize. And as you pointed out, Samantha, you could make that a condition because, okay, maybe this is your dream home and you figured out, okay, I can afford this, but like, what are the premiums going to be? Because that's an additional expense, obviously.
It is. And I remember Wayne Gretzky, he lived in an earthquake zone. And his insurance for earthquake was really expensive. Obviously, he's very wealthy. He can afford to pay it. But a lot of people, may not want to pay that. Like, can you imagine just paying an additional $20,000 a year for earthquake insurance?
Yeah.
Like it's expensive, or you know what I mean? Like it's not cheap. So you either move out of the area, or if you're super rich, you can afford it, and you can afford to have your house tumbled down every 10 years and rebuilt. I guess why not? I don't know. I mean, everything's on a cloud now. You got all your family pictures on a cloud, so it doesn't matter if your house gets all destroyed with the pictures. I mean, if you got the insurance to cover it, that's fantastic. But definitely you should get checked out. Make sure you've got the right insurance for your house, because the cheaper insurance may mean cheaper return when you have a problem. So you got to be very, very careful for that. There's yes, you pay a little more, but guess what? Less hassles. And over my lifetime, I've had a house burned down. One of my tenants, I guess he fell asleep and he had a grease fire and he burned my house down. And so anyway, I got it. So the insurance company came in, rebuilt the house, no problem. I had no headaches. I had the right insurance. It all covered. Guess what? His insurance had to pay for it because he had tenant insurance. And because it was his fault, it wasn't a claim against me. Because if you do have a fire, I'll tell you, your insurance company will cancel your policy 6 months after that fire. Just, they'll pay the claim out. That's it. But we don't want you as a client anymore. And guess what? It's like a driving record. It's on your record. Every insurance company will look you up, and they'll see that you had a claim for a fire, and you're going to pay a higher premium.
That follows the person, not the property, right?
It follows
the person on the claim.
It follows the person. It follows the person, not the property. It follows the person.
All right. Well, let's change gears a little bit here. And for the first time in history, millennials have overtaken baby boomers on debt. I guess this is inevitable, though, because they are the ones who are spending the cash right now.
They are. It's a huge population. So the middle generation now holds 38% of all Canadian debt. And millennials hold the most debt at $911 billion, and about 38% of those of all Canadian debt. Millennials are now the largest debt holders in Canada, overtaking baby boomers for the first time, says a quarterly study out today. Now, of course, the baby boomers got their houses paid for now. So TransUnion Consumer Pulse for the fourth quarter of 2024 shows this group, aged 29 to 44. Well, those millennials are getting older.
It's happening, Rob.
Are you a millennial? You're a millennial, aren't you?
I I am. I'm an elder millennial, as they call them.
Oh my God, that's nice to be a millennial. I wish I was a millennial right now. If I can buy back some years. So anyway, age 29 to 44 hold 27% of the credit accounts. The largest share of consumers by age group in Canada credit market. Now, millennials also hold the most debt. We got that now, but it says the study finds that 26% of Canadians say they expect not to be able to pay at least one of their current bills and loans in full. Wow. See that it's tough out there. It's tough, but that rate rises to 35% among millennials, the highest rate of age group. The Bank of Canada has cut its interest rates from 5 to 3.25% since last June, easing the pressure on indebted consumers. But the study shows that Canadians continue to feel the pinch on their personal finances. Yes, everybody's going through things. Everything's expensive. Now, while economic indicators show that the consumers are likely to enjoy some relief from their financial pressures in 2025, many are still navigating the challenges caused by the highest interest rates since 2001. We recently experienced, said Matthew Fabian, Director of Financial Services Research and Consulting in TransUnion Canada, despite the 22% say that they intend to take on more debt or refinance in the coming year, a sign that some Canadians are turning to credit to make ends meet. It's true.
It is true. I go to home evaluations all the time, and you see what they've bought the house, say 130,000, 20 years ago, and now they owe 380. And
yeah, a lot of people
on stuff. Yeah,
a lot of years ago, a lot of elderly people, they've never remortgaged their house. They just paid it off as fast as they can, and to them it's taboo to remortgage their house. But meanwhile,
sometimes it's smart to remortgage if you're going to reinvest the money and use it smartly, but not just for debt, cars, and living this Instagram life.
Absolutely, and a lot of millennials, I mean, they do remortgage. I get it. They got to catch up, pay their bills, and everything. It's the only way for them to get ahead, and it is tough. But that's what's so the millennials have taken over now, and then now the next generation is Gen Zs. They're 13 to 28 years old. Right now, and they're the ones that are just graduating high school right now. Boy, they're in for a surprise.
University.
Yeah, they're in for a surprise.
Yeah, do you get many Gen Zs coming into the housing market working with the Golfi team?
You know what? If the parents are very, they've got some good money behind them, and they really want their kids to get ahead in life, and they want to support them and go ahead, and if their kids are anxious to buy real estate, you're going to see them buying.
Yeah, that's where you pull out equity on your home, and that's smart equity to help your kids out with a down payment or buying a second investment property. When it's a good time to buy right now, you buy if you're looking to downsize in a couple of years, buy a second property with your equity and rent it out until you're moving in it.
Yeah, rent it to your kid until they're able to, do like a rent to own with them.
Yeah.
Absolutely. There's a lot of that. A lot of wealthier parents are helping their kids out because they know it's going to be a tough go if they try to do it on their own. And it's sad for the other kids that don't have the help and the means to do it. They may have to wait 10 years before they buy a house, but in 10 years house prices double, so it makes it even tougher.
I've had the convo with a lot of parents on taking out the equity on their home, and like you said, Rob, years ago it was get the house, get the mortgage paid off, and no debt, but they don't understand some debt is healthy debt, and it's okay.
Yeah.
But they just don't want to see any debts on their bank statements.
Nobody wants debts, that's for sure.
No, we don't want them, but it's a necessary evil, and you can't take the stuff with you anyway. All right, we're getting into the new year here. Samantha, I imagine you're busy and ready to take phone calls with the Golfi team.
We're ready to go.
Yeah, it started already. The phones are picked up, and things are starting to click. Happening, and we expect a decent year. We expect that we will surpass last year and the year before numbers, and plus, we're always trying to improve our services.
Incredible. Well, with that new home warranty program, you're definitely doing that. If you want to find out more about all that the Golfi team has to offer, give them a call at 905-641-0308. Always online as well at robgolfi.com. Rob, thank you so much for joining us today.
Thank you. Have a great weekend. Sorry.
That's okay. Thank you so much, Samantha.
Thank you. It was great.
Okay, come back again soon. This has been The Golfi Show, and I'm your host, Steph Vivier. Stick around. There's more coming here on News Talk 610 CKTV.